6 million ounces, gone, overnight. That's what just happened inside the COMEX silver vaults. And the CME's response? They just slashed silver margin requirements by a whopping 22%, effective today, March 6th, 2026. Now you might be asking, is this good news? Is this bad news? What does it even mean? Stick with me, because in the next 30 minutes, I'm going to break down everything happening in the silver market right now. The vault drains, the delivery crisis, the margin war, the Wall Street banks under pressure, and, most importantly, what all of this means for your money. Whether you own silver, you're thinking about buying silver, or you just want to understand what's happening in the global financial system right now, this is the video you need to watch. Let's go. Let's start with the biggest story of the day. As of today, March 6, 2026, the CME Group, which runs the COMEX exchange where silver futures are traded, just officially lowered margin requirements for precious metals. Specifically, gold margins cut from 9% down to 7%. That's a 22% reduction in gold margins. Silver margins cut from 18% down to 14%. That is a full 22% cut in silver margin requirements. And this goes into effect today, after the close of trading on March 6, 2026. Now here's the wild thing. This comes after the CME spent the last 3 months hiking margins over and over and over again. We're talking about 6 consecutive margin increases since Q4 of 2025. They've been ratcheting up requirements to slow down the silver rocket ship, but now they're doing a full reversal. Why? Because after silver hit an all-time high of $121.88 per ounce on January 29th, the price collapsed violently. By February 6th, silver was trading at $75 per ounce, a crash of nearly 40% in just 8 days. The frenzy, at least for now, has cooled, so the CME is essentially saying the volatility has subsided enough that we can ease the financial pressure on traders. But here's what's interesting. At the exact same time, they're cutting margins. The vaults are still bleeding silver, and that is the real story. Let me talk about what's been happening inside the COMEX vaults, because this is where it gets alarming. According to data posted on Threads by market analyst Carolyn Fraser just today, COMEX registered silver has plunged by 6 million ounces overnight, going from approximately 87.2 million ounces down to around 81.2 million ounces in a single reporting period. And the breakdown is stark. 332,603 ounces withdrawn from Brinks, 302,938 ounces adjusted out of Brinks. These aren't rounding errors. Physical silver, the kind that actually backs futures contracts, is walking out of COMEX warehouses at a historic pace. Now let me give you the bigger picture to understand how enormous this is. Back in October 2025, COMEX had roughly 532 million ounces of total silver inventory. As of mid-February 2026, that number had fallen to 366 million ounces total, a drop of 31% in less than 5 months. But here's the number that really matters. The total inventory is divided into 2 categories. Registered silver. This is silver that is warranted, tagged, and available for delivery against futures contracts. It's the real ammunition. Eligible silver. This is silver that meets quality standards but is not currently available for delivery. It's sitting in the vault but can't be claimed. As of the latest data, registered silver has fallen below 88 million ounces and potentially closer to 81 million ounces after today's overnight drain. Meanwhile, the May 2026 open interest on silver futures, meaning the number of contracts outstanding, represents over 394 million ounces of silver. Let me repeat that. 394 million ounces of paper silver contracts backed by approximately 81 million ounces of real deliverable silver. That's a paper-to-physical ratio of nearly 5-to-1. An analyst at Choice Broking put it bluntly, open interest exceeds available registered stock by over 400%, creating a significant paper-to-physical imbalance and raising the risk of a liquidity event if contract holders demand delivery. If even a fraction of those contract holders decide they want real silver instead of paper silver, the math simply does not work. Now let's talk about what has been the most watched event in precious metals in years, the March 2026 COMEX delivery cycle. Here's how futures delivery works. When a futures contract comes due, the holder can either settle in cash or demand physical delivery of actual silver. Most people take the cash, but when markets get tight, some players stand for delivery. They want the real metal. On first notice day, for the March contract, February 26th, the market received delivery notices for a staggering 10,526 contracts, representing 52.63 million ounces of silver demanded for physical delivery. That's 43.1% of all standing contracts demanding physical silver on day one. To put that in context, in February, which was also a delivery month, only 1,881 contracts stood for delivery on the first day. March brought 4,540 contracts, a 141% increase. The math gets scary fast. At that point, registered silver was sitting at 86.13 million ounces. The delivery demand of 52.63 million ounces represents more than 60% of everything they had available. And then, while all this was happening, the price went absolutely haywire. On March 3rd, silver spiked to $96.66 per ounce during the Asian session. Then in the US session that same day, it collapsed to $81.40, a single-day swing of 15.26 or 15.8%. For comparison, that's more volatile than Bitcoin. That's more volatile than meme stocks. This kind of price action tells us one thing clearly. There is extreme leverage in this market, and it is unwinding in real time. According to market analysis on Seeking Alpha, silver is showing significant demand, and metal is leaving the vault at a rapid clip. This is a market in backwardation, facing high demand, record prices, and metal leaving the vault. Backwardation, when the spot price trades above futures prices, is a red alarm in commodity markets. It means right now, today, physical silver is more valuable than a promise of silver later. That happens when physical silver is genuinely scarce. So why would the CME cut margins by 22% right now, in the middle of an ongoing delivery crisis? This is where things get really interesting. First, understand what margins do. When the CME raises margin requirements, it forces traders to put up more cash to hold their positions. This forces weaker hands to sell, which suppresses prices. The CME raised silver margins 6 times between late 2025 and early 2026. Each hike helped deflate the silver bubble, forcing out leveraged longs and sending prices from $121 all the way down to $75. But lowering margin requirements makes it cheaper for new traders to enter long positions. More buyers come in, supporting prices and reducing the risk of a deflationary spiral where falling prices trigger more margin calls, which trigger more selling. The silver market just went through a 40% crash in 8 days. The CME's job isn't just to prevent bubbles, it's also to prevent complete market collapses. Because the delivery cycle is not over. May 2026 open interest remains at nearly 395 million ounces, and registered inventory is now potentially below 81 million ounces. The gap between paper and physical is still enormous. Now we need to talk about the China factor, because this is the wild card that is fundamentally changing the silver market. On January 1st, 2026, China implemented strict export controls on refined silver, and the result is that Shanghai silver is trading at a premium of $9 to $13 per ounce above Western prices. For decades, if silver was cheaper in New York than in Shanghai, traders would buy here and sell there, equalizing prices globally. That arbitrage mechanism is now broken. Meanwhile, the Silver Institute has confirmed that global silver is in its 6th consecutive year of structural market deficit. Since 2021, the cumulative deficit has reached roughly 820 million ounces. Consumed by solar panels, electric vehicles, semiconductors, AI data centers, and defense electronics. And new silver mines take 7 to 15 years to bring into production. Supply simply cannot respond quickly enough. Let me hit you with some numbers on industrial demand. Solar energy uses silver in every photovoltaic panel. Electric vehicles use nearly twice the silver of traditional vehicles. AI data centers are rapidly increasing silver demand through servers and connectors. Defense systems rely on silver in radar and advanced electronics. Now let's look at what major financial institutions think happens next. JP Morgan projects silver averaging around $81 per ounce in 2026. Bank of America has suggested scenarios where silver could reach $135 or even $309 in extreme conditions. Other analysts expect prices to stay closer to the $70-$80 range near term, so forecasts range from about $72 to over $300. That tells you one thing clearly. This market is extraordinarily uncertain, so what does this mean for you? If you own physical silver, you are holding an asset that exchanges themselves are struggling to source. If you're thinking about buying silver, understand that the market is extremely volatile. And if you're looking at ETFs or mining stocks, those markets move even faster than the metal itself. But the big picture is this: silver is no longer a quiet commodity. It now sits at the intersection of AI, energy transition, geopolitics, and global supply shortages. All right, everyone, let me bring this all together. The CME just cut silver margins by 22%. 6 million ounces left COMEX vaults overnight. Registered silver inventories are near historic lows. Industrial demand is exploding, and forecasts for where silver goes next are all over the map. The truth is, nobody knows exactly where the price goes from here, but one thing is clear. Silver is no longer the sleepy metal it used to be. If you found this video valuable, hit like, subscribe, and ring that bell. Drop your thoughts in the comments. Are you buying silver at these levels or waiting for a pullback? I'll see you in the next one. Disclaimer: this video is strictly for educational and entertainment purposes only. Nothing in this video is financial advice, investment advice, legal advice, or tax advice. I am not a registered financial advisor. Silver and precious metals markets are extremely volatile, and you can lose money. Always conduct your own research and consult a licensed financial professional before making investment decisions.